In today's video, we're going to go over Goldman Sachs and JP Morgan. And first, we're going to go over some of the basic rules. And that is that 23% and 38% should always send you back to a new high or a new low. Any failure to do so will cause a change in trend. You can also make a slightly higher high or slightly lower low and get right back in the range, which will have the same effect. Also, anytime that you've hit 23.6% and reacted and then failed to make that new high low, it is less likely that 38.2% is going to hold. It can, but less likely. Next is 61.8 and 78.6. Both of these will cause retracements equal to that in the opposite direction. So if we're talking about 61.8, you're going 61.8 the other way. Same with 78.6. These are just the basic guidelines to watch for. And now we'll just take you through what has happened. We'll start with JP Morgan. And we're going to start with the high here that they made at the beginning of the year. Now, to go back any further and to understand where the market came from and how it got where it got, you can go back to the ONE44 Analytics blog, and you can look in there and they will explain how we got where we are. So for right now, we're looking at the high and this first setback right here, 23% back to the December of 2018 low. This here held 23.6%. Now, we know that by holding this, we should be going for a new high. And in this case, we failed to make the new high. But what's even more interesting about this, and always something to keep an eye on, is that many times when these markets fail like they have here, it ends up being 78.6%, which you just had right here. So you see this level here. Now this is telling you that, one, we should be going back at least down to 78 the other way. But more importantly, the bigger picture, which you always have to keep in mind, is we hit 23.6% here. Failed to make that high, new high. And as we said, less likely to hold the 38% level. As you see, they blew right through that. Now, what happens whenever we go through 38%, it's telling us the trend is changing and we want to start watching it the other way. So what happens here is we just take this to this low right here, and as you can see, it's 38.2%, telling us the market should go for new lows again, which obviously it did. Now, when we get all the way down to this low, it happened to hit 50% back to 2009. Now, that's not a Fibonacci retracement, that's GAN. But even if you don't have any reason for the low because of the trend change, what's more important is the retracements back up. Now, in this case here, we'll get rid of this one. We see that 38.2% on this break, which is the most important thing to say. Is this going to continue down, or is this the turn? Well, you had one close above it. And as we always say, that you want to see two in that direction to say that something's really changed. Now, when you get a close above it and then right back below it as we did here, the effect is still the same. We should be going for a new low. Now, the interesting thing here once again is that the failure down here to make a new low came right back into 78.6%. This happens a lot, and you need to keep an eye on it. Even though you know, or the theory is that we should be going for new lows from the 38.2, we don't just ignore everything else. We have to watch and see what really is going on. Now, another thing from whenever you hit 38.2% and you don't make a new low, and or you make a slightly lower low and get back up into the range, the next target becomes 61.8. Well, sure enough, that's exactly where we went after hitting 78.6, hitting 38, failing to make a new low, right up to 61.8. Just so happens to be the 200-day average too, but we're talking about retracements here. So now 61.8 rule tells us we should be looking for 61.8 the other way. So this here gives us our two targets, right? Ideally, because it's 61.8, we are looking for 61.8 the other way, and this is down around the 92 area. Now, these areas become so dynamic and are so important that if they end up getting back up through here, then we're looking at 78%, and that would be at the plan B. But plan A is that because it was 61.8, it should go 61.8 the other way. Now, you're also going to watch going forward any break from this area and start measuring the things on the way back up just to see how weak or how strong the market is. And in this case, if we go from here to here, we can see, it got up above 38%, but right back above it, still keeping it negative, still keeping the idea that we are looking at 61.8 down here in the 92 area. Now, what happens a lot with 61.8 is that it tends to put it into wider swinging trading ranges, and this is what we could be looking at. So from this 117 area, we're looking for 92 down below, and then we'll look for 61.8 back up around the 109. So this can continue on for a while, and that's the thing. 38 and 23.6 are always going to keep your trend solid and strong, looking for the direction to continue. 61.8 and 78.6 are always going to send you into very choppy markets, so just keep that in mind. Now on to Goldman Sachs here. We're going to start with the same thing, the high at the beginning of the year. And this here, as you can see, from the move from February or March of 2018 down to the 2018 low in December, 78.6 was right here at this 250 area. That's what stopped this market. Now again, as we said before, 78.6 should send us 78.6 the other way, which is a lot lower, but we're still going to look at all the things that are going on within that. So as we go from here, let's just take this back out a little bit. Now we have, we take this here from this secondary low. We see that we held 23.6% in here, failed to make a new low. Again, we know that 38% shouldn't hold because of the same thought that once you've reacted, which you did up there from 23%, that the target or that 38% isn't going to hold or is less likely to. It can, but less likely. Okay, so we have a turn up in here, up on top. We know it's 78.6. We know we should be looking for something much bigger, but what's the target on the downside? So as this market just falls apart, we go out to then the weekly chart, and you can see that, move this out of here, back to the 2008 low, what we hit was 61.8 down here at 133. Okay, so we know that now. This area right in here is there, so I'm going to take this retracement out. But we have to remember that 61.8 should send us 61.8 the other way. That's the big long-term picture. Doesn't mean we ignore everything else. Now here's another thing that's very important to watch. You have two highs here. You have the most direct high, and then you have the all-time high. Now when you have stuff like this, and this is the key to going back far enough so you don't get caught like this, is that you can see here that 38 or 23.6 of this move here, they kind of looks like, got right up through it like it wasn't there, but 23.6% all the way back to the all-time high, got its head above, right back below, didn't make a new low. Okay, well, that tells us that something's changing, right? I mean, 23% should have sent you to new lows. It did not. So, but then again, we know that 61.8 down here should be sending us to 61.8 up on the upside, but we'll get to that in a minute. So again here, 38% to this high here, looks like didn't stop it at all. It wasn't even there. But we go back to the all-time high, and we see here that this whole area in here reacted to it very well initially, spiked above it, but got right back below it. Okay, so how weak or how strong is this market? We have to start weighing it. Let's just say that this said the market was turning back up, even though it got back below it, or not. But the point is, we're still going to watch it going back down. So when we take this retracement and we look here and we say 38%, they got below it one day, never closed below it. That's telling us this market's got some strength, okay? Now this just adds more to the fact that the 61.8 down here is telling us we should go to 61.8 the other way. But also the fact that 38% reaction could only go 38% tells us that we should be going for 61.8 also. So all of this points up to this area, and which they hit. Okay, this was 61.8. Now you also have the area that from this level, it came right in between 61.8 and 78.6. So between the two of them, they're saying that we should go 61.8 back, which would be 65 half at a minimum on that, and then also possibly even 78% because that's what we hit on the tighter move. Now that just brings us then back to what we're looking at from here. So just like in JP Morgan, we're looking at, because this was 61.8 here, we are ideally looking for 61.8 the other way, plan A. Okay, if this gets taken out and they close above it, plan B is 78% of this whole thing. But again, we're looking that we're not going to ignore any of the other levels. Just because we think it should go to 61.8, we have to watch the 23%, 38%, which they traded down below it to get the 200-day. Again, not what we're talking about. But if all the break from this area can do is take us to 38%, it's telling you this trend is still in control and is very positive. So any level that any setback that would hold 38%, we now know that because, what's the next level? We already reacted to 61.8. We should be going for 78.6. So that's plan B. But as we've been saying, you can have your targets, but you still have to watch what it is reacting to. Always very important to keep an eye on. You have to know where you are, both in just the minor setting and also where you are in the extreme, just as we showed here with, this being a higher high, the all-time high, even though this was the most direct high. We need to know both of these. It very well could have just reacted to the tighter one, but you need to know them both, because you'll get yourself stopped out in areas by not understanding or not seeing where the longer term levels are with all of this. So once again, you can find all these rules and guidelines and examples on the 144 blog, and we'll just check up back on these things to see just what exactly did happen from the levels that we just hit. Thank you.